All right, we are talking about Goldman Sachs and how they've dominated this last century on Wall Street. When we're building out the good merger model, I was very adamant that we really study the history and understand the path of Goldman Sachs because they have been so dominant. But I also think that if you're interested in private equity, if you're interested in building your holdco, Goldman Sachs has been at the center of this space. And private equity is part of that. Buying and selling businesses is part of that. And so when you have a firm that is that dominant in one of the most cutthroat industries and spaces that you can be in for as long as they have been dominant, I think there's a lot to learn from them, whether you're a part of a good merger or just going out and doing deals. Like I mentioned, this space is cutthroat. The competition is completely relentless. And so, to study a firm like Goldman Sachs is studying one that has managed to not only just survive that, which we know some major billion dollar firms that I'm going to talk about today that have gone out of business, but they've also been able to thrive for more than a century and become this brand. It's like an iconic symbol of Wall Street itself. So it's a firm that on one end, there are plenty of people that admire it, and then there are other people that just have it at this place of being this despicable, horrible thing that's known for ruthlessness and all that. Truth is, regardless of what you think about them, they are some of the best risk managers, some of the best deal negotiators, deal makers. And so I wanted to go through this kind of story and highlight some of the things that I love about Goldman Sachs and as far as just business lessons, and talk about some of the mistakes and horrible things that they've done as well. But the things that I love is that they built this culture of ambition. They built this culture where the whole team and everybody involved with their business understands the bottom line and growing and building the profit of the business and helping to drive it towards victory. So in order to understand Goldman Sachs today, I love to go all the way back to the origin story. And it started with this guy, Marcus Goldman, back in 1886. He was a Jewish immigrant. He had made a good bit of money in the clothing business, but he saw a much, much bigger opportunity in finance. So he recognized the need for small businesses to get access to financing. It's the same thing that we recognize today. It's always been a difficult thing for small businesses to get access to financing. So when we look at Financier Bank and what we do, how Fiji provides financing, it's one of the tougher things because you've got to understand risk. He realized that one of the easier ways to do this was to offer accounts receivable financing, which is something that I owned a business years ago called Factor Lane that I sold. Man, it's been 10 years. It's crazy. So he realized that basically factoring was a better option than trying to work with them to broker bank loans because the bank loans were so hard to secure. This is before you just had to be a big business because they didn't have credit. They didn't have a lot of things that we have access to now to look back at history. So he started offering to buy short-term debt at a discount, and he later resold that. And that's what that is. So accounts receivable is basically just when you're looking at a business to buy, you should consider that short-term debt. So he would buy it at a discount. He would basically later resell it to either them by collecting money or to other investors and bankers at a higher price point. So the short-term loans eventually evolved into what's known as commercial paper today. For small businesses, most people still call it factoring or accounts receivable. But this marked the beginning of his investment banking business. And, I love telling people most of the time, what you're doing, it can be grown into something that's much, much bigger. And that's exactly what Marcus proved is, through the Goldman business, which I keep saying Goldman Sachs. At that point, it was not Goldman Sachs. We'll get to that in a sec. But over the course of 10 years, he grew that business to the point of selling around $30 million worth of commercial paper annually. Now, to grow a business that big is a realization like, oh, wow, this thing is serious. And he started to think of like, okay, what happens when I retire? How can I build this into something that lasts forever? And that was when that transition happened. So he brought in his son-in-law, a guy named Samuel Sachs, who the Sachs family was already kind of connected to them. But he wanted to make sure that he brought somebody into the business as a partner that was going to ensure that it continued and thrived as a family business, even once he was out of the business, once he retired. So by 1896, Sachs had expanded the firm's capital. And this is an important thing. So when you're looking at getting into this world of investment banking, a big part of what makes what you can do possible and expands your capability is how much capital you have. So when we're talking about 30 million before, that's just moving, buying, and selling. And so a certain amount of that capital, you're going to take it home, a certain amount of that capital, you're going to leave in the business. So at that point, the business of issuing and trading all the commercial paper was getting saturated. So they couldn't get much bigger than it already was. So if they were going to grow it any further, Goldman had to find the next kind of big thing in their world and finance that was going to allow them to grow. And the most logical thing was going into IPOs because it's a much bigger business. So, in the world of commercial paper, it's only so big. With IPO, you could just work with a lot larger companies. And the biggest downside to that was that taking companies public was dominated already. So it was dominated by firms that had elite brands and had European heritage, if you want to say, not only European heritage from the sense of the brand, but also European, just white people. And there was a lot of racism between white and Jewish people, which for black people, especially, it's just what, y'all look the same. It's so interesting. But Goldman Sachs was considered an outsider of Wall Street. People, whether it was the clubs that they went to, it's no, you couldn't come. And back then, just racism was overt. It wasn't oh, we're going to try to trick you into thinking that we're not doing business with you for some other reasons. Hey, we're not going to do business with you. And you're why not? It's because you're Jewish and we don't do business with Jewish people. And they may not say it that nicely, but it was very overt, especially on Wall Street. So they were determined and they had to figure out a way, okay, how can we work our way into this IPO underwriting business? And they just had to figure out where to start. And one of the ways to get around the system was to figure out, okay, we need to find a very strong, big Jewish company that we can work with. Now, even most of the Jewish companies still were going with the European brands, if you will, at that point, because they had the buyers. It doesn't matter if you're trying to underwrite taking a company public and you don't have people to buy the shares. It doesn't matter. It's hey, we can't go with you. It's great. We love that you're Jewish, but we got to sell our shares. Now, in 1897, I love Sears. In 1897, Sears had a net worth of $250,000. By 1905, it had grown to about 37 million. Love all of that. One of the reasons I love Sears is I did a training that's in, I guess that's in Patreon. It's not on YouTube. And we go through in Acquisition Hoco. It's one of the businesses deals that I love later. It's Eddie Lampert's deal when he put or merged Kmart and Sears, because the deal was an absolute failure, but the fund made a ton of money through, and basically these were two businesses that were going out of business. So he knew, hey, these things are going to go out of business, but I think I can make money. And through some financial engineering, he was able to do some pretty cool things with those deals. But it is an amazing case study in no matter what happens with a business, if you're doing things the right way, you can make money. So the business had grown to 37 million in 1905. It was doing about 2.8 million in income. But for Goldman, it was that was the perfect candidate for them because it was big. It was a large business. It would put them on the map. They were Jewish, so at least they wouldn't get turned down because they were Jewish. And they just had to make sure that they could actually sell the shares. So what they did was, to make sure they could sell the shares, they went and partnered up with another Jewish firm. Because again, they couldn't partner with the elite firm. So they found Lehman Brothers, which I mentioned, not everybody made it to today. Lehman, despite growing to be an amazing firm in and of itself, went out of business just a few years ago. So they partnered together. They wanted to underwrite $30 million of common stock and $10 million of preferred stock for Sears. And the deal was successful. So the success of the deal brought a lot of other companies to their doorsteps because it solidified Goldman Sachs. It's like, okay, this is a prominent investment bank that can get deals done. At the end of the day, that's one of the things I love about doing deals is that can you get deals done or not? That's what matters. So you move forward from there and you get into the roaring 20s. That was when most of you who are following me know there was a huge boom. It was a boom in the stock market. Business was booming. People were making money. At least everywhere you look, there was gold rush. There's just like all these things happening at once. Oil, all of these things happening even outside of stocks themselves. And so Goldman Sachs wanted to capitalize on that and formed a trading corporation. So they raised capital and made millions in this trading corporation. But as we all know as well, like all booms, they eventually come to an end. And that one did in October of 1929 in the infamous Black Tuesday. So Goldman Sachs did suffer in that. They weren't, and I think this is one of the important things. It's not like everything's just cherries and blossoms when you're in this world, or even when you're very, very smart or you're very, very good. You can be the best in the world and you're going to suffer losses. The key is, even when I was talking about Eddie Lampert and Sears, like, how do you respond? How creative can you get? How can you figure out a way around it? That's what's going to determine how well you succeed, not being able to never suffer losses. Like, that's not going to happen. So Goldman ended up suffering some very, very significant losses. But Sidney Weinberg, who was in the firm and just one of my favorite figures outside of Marcus Goldman in the history of Goldman Sachs. And at that point, he was influential within the firm, and he was able to go to clients and kind of keep the firm intact, keep the clients loyal, keep the investors loyal. And one of the things I love about Sidney Weinberg is, his ability. If you ever get a chance, I recommend reading the history of Goldman, so you can really dig into his history. But his prowess in building relationships and networking, I mean, it's unmatched to this day. He literally had the nickname Mr. Wall Street. So he brought in this steady stream of deals, which is the most important part. It's at the foundation. And these are investment banking deals. So these aren't deals in the sense of buying the businesses, but it's investment banking deals. So you've got to have those deals coming in so that you have basically the product to sell to investors. And under his leadership, Goldman Sachs was able to get through the Great Depression, which we saw in 2008, which was nothing compared to the Great Depression. How many firms just went out of business? Now, the really amazing thing about what Sandy achieved was that at the end, it was in a position to kind of get to the point that it is today, because it emerged as a stronger entity. So he went to work kind of rebuilding this thing so that it was stronger. After him, he had a successor that followed him that kind of took over the firm. One of the things that you'll find in a lot of these firms, sometimes it's not even the person that's named CEO that's really leading the firm. It's kind of which part of the business is leading the firm. Sometimes the trading side is leading the firm just because they're making the most money. So they're going to be able to say, hey, I don't care who you are. We making all the money. Sometimes the investment banking side, sometimes the debt side, so you just have all of these different parts of the business. The real key is, what is the revenue source? Gus Levy, he was really focused on the trading side of the business. Sandy was really focused on the investment banking side of the business. So he wanted to increase the trading side and increase that revenue source for the firm. Now you fast forward all the way up to the 70s, and then it got into a whole other set of issues and problems. And this is when they started to face some legal troubles. In the 70s, they had a insider trading scandal, and they had to have some settlements with some various companies where people got in there and got a little too greedy. But the firm obviously was able to survive and continue to grow. Another leader that had a very big impact was John Whitehead. And he came in kind of after all of that to help restore. He had just a really great reputation on Wall Street, and he was able to restore the firm's trustworthiness and laid the foundation for some future growth. Those insider trading stories, again, in the book, is just those are very interesting to read and check out. So I definitely recommend that because it's interesting. But he comes in and kind of tries to fix that after some major payouts. That again, but it wasn't just like, oh, we did this sorry and now it's going to go. It's like it was like SEC was like, no, we're going to try to put you out of business almost. So they had to come back from that, which was a lot of the 80s. And then you get to the 1990s, which the biggest thing in the 90s for Goldman Sachs was going public. They had always been this partnership, and they were going to transform from being a partnership into a publicly traded company, which I trade in. And just this week have made some money off of selling puts on. So that the reason was that it was going to, number one, everybody else was going public, and so they had to compete with them. And the reason that the competition was really crucial is that it allows you to get access to more capital and just allows you to expand your business by going public. But there's a downside. Going public also brings more scrutiny. It brings more legal challenges. One of the biggest allegations that they faced was in 2008, profiting from the financial crisis. And, when SEC can literally just come in and see everything, it's tough to hide what you're doing. So you have to be able to explain every decision that you make and make sure that it really is on the up and up. And when you got thousands of employees making these decisions, you really have to be on your P's and Q's. So one of the smart things they did was in the early 2000s, they were able to capitalize on the boom in the mortgage-backed securities industry, which a lot of folks did. And so, as we all know, that eventually led to the 2008 financial meltdown. And what people on the outside were saying is like, they were basically misleading investors and profiting from the crisis. So it's funny to watch some of the trials. They had to go before Congress, and the emails came out where somebody would sell something to an investor, and they said, "I can't believe this guy just bought this dog crap," and he didn't say crap. So. Bottom line was, like, in the aftermath of the crisis, they had this very tarnished reputation. But again, they were able to survive it and regain their market position. So when you look at Goldman's just ability to continue to adapt, to continue to evolve, it's pretty incredible. Eventually, like I was mentioning, it ventured into consumer finance. I have an account with Marcus after the original Marcus Goldman, and they're basically targeting investors outside of kind of corporate clients and that kind of thing. And that did well back in 2020 with the market boom. So if you look at this journey, just expanding like over a century, I'm very curious to get some of y'all's thoughts on Goldman and see, how you feel about the Goldman brand and all of that. But at the end of the day, Goldman has been at the center of a lot of financial events. I mean, if you look at, I just kind of wanted to run through those from the eyes of like these major financial events. Booming in the 20s, making it through the crash after that in 29, going through the issues in the 50s, having the legal issues in the 70s, then coming back, trying to build a brand in a different way, getting into different spaces, figuring out, oh, wow, this mortgage thing is going to be huge. Then realize in 2008, oh, no, here's the mistakes that we're making. The rise to prominence is never just this easy kind of up path. It's usually driven by the ability to spot different money making opportunities, execute on the strategies better than competitors, but most importantly, it's just a relentless pursuit of deals. And that's what I want you to get from this. This is what I hope you are doing in your deal making business, so that hey, one day you can be this business that 100 years from now, some kid is talking about how cool it was that you launched this and built it into this behemoth. Now, we talk about a lot of these strategies all the time in the Acquisition Holdco program. If you haven't gone through our solo conglomerate free course, do recommend that you do that. But regardless, definitely like the video, put a comment, join us in the Patreon, and I look forward to getting some of y'all's thoughts and feedback on Goldman. Let me know if this is something you'd want me to do. I'd love to talk about kind of some of the other case studies in the space that we try to learn from, like Carlisle and the history of Blackstone and KKR and some of those things. Let me know if you're interested in that, and I will do some of those. Subscribe, like, and I will talk to y'all soon.